With the world seemingly going to hell in a handbasket, I thought it might be worthwhile just to have a quick look at some of the major moves that are occurring in various markets and try and get a picture or a feeling of what is happening, what markets are moving, what markets are not. You'll note I didn't say try and make sense of the markets, because that's a pointless endeavour. What that means is that you're attempting to construct a narrative that you want to apply to the market. So you want to apply boundaries around the market based upon your thinking. Again, we come back to this notion that the only view that counts is the market's view. Your view and your narrative, my view and my narrative, are completely irrelevant. So what I thought I would do is look at the 1 month relative performance of a basket of fairly commonly traded commodities. I picked 1 month because that encompasses the build up to the conflict in Ukraine and what is happening now today. And there's a few things to note, a few things that sort of stand out when you look at this relative performance. As you would expect, up the top of the list is the energy complex. That's to be expected. We're back to this notion of when there is massive global uncertainty, the thing that is most responsive or most reactive are energy prices. Despite our attempts to move away from oil as the base mechanism for running our economy, we have not reached that point yet. So it remains an economic staple. It remains a key component of all economies. Add into the mix that Russia itself is a large oil supplier, and you do have this sort of perfect storm for what is occurring within energy markets. I've highlighted gold here in purple as opposed to green for the other precious metals, because what has been surprising is its lack of performance up until now. And I'll come to that in a moment. You'll see that palladium and silver, based upon this little chart, have been outpacing it, as has platinum. If we were to go back in time and have this sort of exercise, we would see that gold would be one of the best performers. But as we will see, the show is not over yet by any stretch of the imagination. And as you would expect, the poor performers have been the indices, particularly those European indices such as the Euro Stoxx 50 and the DAX. That should not be surprising, but intriguingly it has been surprising to many commentators, because much of the commentary I've read regarding the relative performance of European indices versus those in the US is how poorly the European ones have done. This again causes me to sort of fall back on my belief that most American commentators have never come across an atlas. So they don't actually know that the war's occurring in Europe and that Germany is in Europe. So therefore they're very, very surprised by this relative underperformance of European indices. What I've done here, this chart looks the same. It's not. This is the 1 day relative performance, which I snipped this morning. And you can see that Brent crude is up 8.8% this morning. West Texas up 7.9, heat oil up 7.2. Intriguingly, wheat is up 6.61. Traditionally, if you look back at history, Ukraine has been regarded as sort of the breadbasket of Europe. And so that's not surprising when you start to think about it. And you also see a mix of precious metals in there. And again, down the bottom, the poor old DAX is still taking somewhat of a flogging. Again, to be expected. There should be nothing within this chart or the previous one that should surprise anyone. These are the usual suspects performing in the usual way when we get this sort of event. This does bring us to the point of, well, what does it mean in any way, shape or form? And what I have here is a chart of Brent crude. It was blindingly obvious to everyone that once Brent broke the 87 barrier, it was going to take off. Granted, the extension move to 125, now 130, is extreme, but it's really, really quite obvious. What surprised me was the large number of Twitterati who were saying that it could not possibly go beyond 90. It did. So they said it couldn't possibly go beyond 95. It did. Then they said it couldn't possibly go beyond 100, and it did. Once this Twitterati becomes bullish, it might actually be time to start moving your stops a wee bit closer. Because by and large, the wisdom of the crowds is no such thing. It should be termed the wisdom of idiots, because they are a collective bunch of idiots. But it does show you the power of being simple in your approach. All crude had to do was move to a new high, and that was it, you're a buyer. There is no conceivable reason why you would be bearish this instrument in the run from 87 and beyond. To do so is simple folly and to ignore what the market has been doing. Gasoline looks the same as you would expect, but gasoline had a small retracement back to the moving average, then took off again. So once again, once we broke the 255 mark and we're headed towards 260, with the notion of a war in continental Europe beginning in full swing, it becomes obvious that this is a buy. Now let's leave aside the narrative, because the narrative could be anything. If you just look at price action alone, you'll see the bottoming in December, price moving from the 190 mark to 250, 255, where it ran into the previous high. It took that out quite easily. Yes, there is a small retracement, but the small retracement is simply a buying opportunity. It is nothing other than that. It's not a mechanism or a reason to panic. So this is the general picture of energy. And if I was to look at heating oil, it would look the same. The exception to the rule here is natural gas. It does look different. So as part of that complex, it is the odd one out. In terms of precious metals, it's intriguing how the two stalwarts of gold and silver have, to a degree, not really performed up until now. And one should never couch these things as certainties, because they never are. And we can see that for the last 4 or 5 months, silver has been range bound. It is now testing that range. It is now looking at moving beyond that as buyers flood into the market. And that's to be expected. The interesting thing about drawing straight lines is that they are immensely powerful but immensely simple. Yet what always intrigues me is people's refusal to use them because they are so simple. People would much rather plaster the chart with all sorts of complex bibs and bobs instead of just drawing a straight line and saying to themselves, below the line I am neutral, above the line I am bullish, or I've now bought the position, what do I do? Well, now comes the skill of managing the position. And despite what perhaps popular wisdom is, it is managing the position where the money is made. The money is not made on the entry. The money is made on how much of it you manage to keep throughout the move itself. This raises the inevitable question of what to do now when you have this sort of runaway move. The first thing is not to panic, and panic takes two forms. Firstly, people sell out of a position preemptively at the first sign of any form of movement back against them. That's simply weak hands. During these times of when the market is offering you the chance to be very profitable, and that's what it's doing, it's saying to you right now, you have this position, do you wish to be profitable, yes or no? And every time the market opens, it asks you that question. And it's a very simple but very powerful question, because most people don't want to be profitable. And so they will enact strategies that prevent them from being profitable. They will sell out of a position too early. Now they will rationalize that on any number of grounds. And everyone has heard of the old sort of chestnut of, you can't go broke taking a profit. Well, that's exactly how you do go broke. Because what happens is, let's play a thought game. If we come back in a year's time and we revisit these markets, we might see that these moves in the energy complex were the only bullish moves of this year. And if you haven't gotten them, you've missed out for a year. So it's incumbent upon you to take everything that the market has to offer. So the first step is not to panic. The second step is to manage your stops, but to manage them in a way that is not a mechanism for expressing your panic. So you don't jam your stop right up against price in the belief that you will capture most of the move. What will probably happen is you'll get taken out by a spike. You're then left with this regret and wondering as to whether you should re-enter the position and go again. And those decisions are always very, very hard to make. And my experience has been that you generally get them wrong, that it is best to stay with the position until it quite naturally comes to an end. So in terms of indices, I know there is much panic in the US regarding what is happening with their market. And to be honest, quite frankly, I can't see it. I understand the market has come back and is now in drawdown from its previous peak. But at present, the bark is much worse than the bite. Because if we look at this chart of the S&P 500 with drawdowns plotted, the last double-digit drawdown for the S&P 500 was as COVID broke, and the market dropped 10%. That stands in sharp contrast to the GFC, where the market did a very, very good impression of halving. So whilst there is talk of panic in the end of the world, I think what you're seeing there is a clash between reality and expectations. The expectation of the current generation of traders / investors is that the market never goes down. It's as if for them the law of gravity has been repealed in some way, shape or form. And so this pullback that we're seeing, which to date is only 9.1%, has put the willy up them. And that's a function of their poor psychology and poor understanding of markets. Now that's not to say that this is bullish by any stretch of the imagination, but it is to temper the notion of panic in the end of the world with reality and systems-based reality, and reality based upon the numbers that you actually see on the screen, not what your perception of the number is, what the real number is. And the real number at present is that the S&P 500 is having a drawdown of 9.18%. And if we look back at this chart, going back to 2008, we find that that's not unusual. That seems to be part of the natural market cycle. Markets go up for periods, then they encounter periods of weakness, then they recover. That's not to say that lasts further, because there are periods when markets go sideways for decades, or they go down for decades, as in the case of the Nikkei. But again, temper your panic with an understanding of history and an understanding of what's actually happening in the world. And just to sort of add to that and round it off, if you had invested $10,000 in the S&P 500 as the GFC ended and the market began to recover, as of Friday's close, that would be worth $54,255. That's not a bad return for sitting on your hands doing nothing. So again, it's a matter of balancing the reality of what you see versus the emotional expectation of what you feel, and that the two are contrasting. Data does not deal well with feelings, and feelings don't deal well with data. Feelings are often immune to data, and unfortunately as a trader, that's a continual battle that you have. But you can only ever default to data. You can't default to feelings because they're nonsense. In terms of the short term, there is no doubt in the short term that the S&P 500 has been trending down. And some of the moves down have been enough to rattle people quite significantly. But again, viewed in the context of history, these things are not unusual, they're not new. This is not a sudden invention of 2022. This has been going on since markets began. In terms of the DAX, there's not much to say here other than the fact that it is taking a little bit of a caning, and it is down about 19% from that peak of 16,500 or thereabouts. Again, to be expected, because Germany sits above the crisis. And so you should expect that its geographical proximity to a war would have an effect on its market. To be surprised by that merely demonstrates that you're a functioning moron. So take-home points. Prices will move further than you can ever imagine. That's the nature of price. Your opinion as to how far it will go is irrelevant, and it offers nothing to the trading equation. But once on board a position, don't be panicked out by noise and chatter and what other people think. Other people are not trading your money. So let price do its thing and in turn make you profitable. I come back to that point I made. Every morning when the market opens, it's saying to you, I am offering you the chance to be profitable. Do you wish to be profitable, yes or no? Sadly, most people respond with no. And finally, things will change. And whilst it is a hackneyed, somewhat silly statement that change is the only constant, in markets that is true. And when we look back at this in 1 year, 2 years, 3 years' time, things will be different. But in terms of a final word, as to the genius level of advice that is being given by advisors out there, this popped up on my Twitter feed, and I'll just read the bit at the bottom that's been circled. It says, bottom line, the risk of Armageddon has risen dramatically. Stay bullish on stocks over a 12-month horizon. So I interpret that to mean that if we do have our own Dr. Strangelove moment, I really should race out and buy BHP.